Hi guys, how are you doing today? Hope you are doing great. Welcome back to my channel. This is Phenomenal Pips. In this video, we are going to discuss how to trade patterns, candle formation, and all that. Please stay tuned.
We will be covering the main patterns. Candlestick patterns, to start with, then we will cover the most common chart patterns. In the first part of our course, we saw that charts are a graphical representation of a series of prices over a set time frame. They represent the money on the table at the end of the day. That's why they are so important. Technical analysis relies on your ability to read the charts and the price data. Charts are a widely used tool in trading and investing to quickly see the past performance of the currencies and stocks, the highs, the lows, trends, trading volume, etc. As we said before, there are different types of charts representation. The line charts, the bar charts, the candlestick chart. The last ones are widely used, because of their ease in quickly determining the information, the color variations indicating up and down days. Candlesticks are good indicators of what is likely to happen in the near future, with respect of the price of the currency pair. Many candles have been named, to identify them, and have to be looked at closely when seen on a chart. Besides, identical candlesticks may have different meanings, depending on where they occur within the context of prior trends and formations. Let's start with the candlestick patterns. Before we get started in candlestick patterns, there is a quick test I would like you to make. This would save you the hassle of learning all candlestick patterns. While they might be of use to pure technical traders, and while I believe all knowledge is good to take in, I do not personally look for candlestick pattern. For one simple reason, and that is the reason of this quick test. Based on the three candlestick, would you be able to choose the most bearish candlestick? Meaning, if you were to see this, let's say around a key level, which one would give you the most confidence in selling? A, B, or C? Why C? The reason lie in the reading of the candlestick, and if done correctly, will save you lot of time in learning all candlestick patterns. If we take a look at what is happening, one by one. In A, we have our price opening here, the sellers are pushing the price lower, but then the buyers are pushing the price all the way up. The sellers are still in control as the price close lower, but this is a warning that there is heavy buyers pressure below. On B, the seller are in control and the price is falling and close below opening. While this candlestick seems to be the most bearish, they are not telling us much, apart from the fact that sellers outnumbers buyers. In C, however, the sellers got pushed back early on by the buyers, the price is then pushed back by the seller, not only all the way down, but even lower. This is a clear demonstration that the sellers are in control, and that they want to see lower price. It might also keep away further buyers at attempting to buy this level. The first pattern is the hammer. The hammer forms after a downtrend, when it reaches a support level. The candlestick has a small real body and a long lower shadow, at least twice as big as the real body. There is no, or almost no, upper shadow. The real body can be either red or green. The hammer candlestick formation is viewed as a bullish reversal candlestick pattern, that mainly occurs at the bottom of downtrends. When the high and the close are the same, a bullish hammer candlestick is formed, and it is considered a stronger formation because the bulls were able to reject the bears completely, plus the bulls were able to push price even more, past the opening price. In contrast, when the open and high are the same, this hammer formation is considered less bullish, but nevertheless bullish. The bulls were able to counteract the bears, but were not able to bring the price back to the price at the open. The long lower shadow of the hammer implies that the market tested to find where support and demand was located. When the market found the area of support, the lows of the day, bulls began to push prices higher, near the opening price. Thus, the bearish advance downward was rejected by the bulls. The hammer is an extremely helpful candlestick pattern, to help traders visually see where support and demand is located. After a downtrend, the hammer can signal to traders that the downtrend could be over, and that short positions could potentially be covered. However, other indicators should be used in conjunction with the hammer candlestick pattern, to determine potential buy signals, for example, waiting a day to see if a rally off of the hammer formation continues, or other chart indications such as a break of a downward trend line. But other previous days' clues could enter into a trader's analysis. Shooting star. It is the mirror of a hammer pattern. The formation must be on an upward trend. The distance between the highest price for the day and the opening price must be more than twice as large as the real body. The distance between the lowest price for the day and the closing price must be very small or non-existent. If the candle was green, opening price lower than closing price, it would still be an early warning for a reversal, maybe not as strong. The shooting star candlestick formation is viewed as a bearish reversal candlestick pattern, that typically occurs at the top of uptrends. When the low and the close are the same, a bearish shooting star candlestick is formed, and it is considered a stronger formation because the bears were able to reject the bulls completely. Plus the bears were able to push prices even more by closing below the opening price. The shooting star formation is considered less bearish, but nevertheless, bearish when the open and low are roughly the same. The bears were able to counteract the bulls, but were not able to bring the price back to the price at the open. The long upper shadow of the shooting star implies that the market tested to find where resistance and supply was located. When the market found the area of resistance, the highs of the day, bears began to push prices lower, ending the day near the opening price. Thus, the bullish advance upward was rejected by the bears. The shooting star is a candlestick pattern to help traders visually see where resistance and supply is located. After an uptrend, the shooting star pattern can signal to traders that the uptrend might be over and that long positions could potentially be reduced, or completely exited. For aggressive traders, the shooting star pattern illustrated above could potentially be used as a sell signal. Generally speaking though, a trader would wait for a confirmation candle before entering. The bullish version of the shooting star formation is the inverted hammer formation. Hanging man. It has the same shape as a hammer, but occurs in the context of an uptrend. The real body can be either red or green. The hanging man candlestick formation, as one could predict from the name, is viewed as a bearish sign. This pattern occurs mainly at the top of uptrends and can act as a warning of a potential reversal downward. It is important to emphasize that the hanging man pattern is a warning of potential price change, not a signal, in and of itself to go short. When the high and the open are the same, a bearish hanging man candlestick is formed, and it is considered a stronger bearish sign than when the high and close are the same, forming a bullish hanging man. The bullish hanging man is still bearish, just less so because the day closed with gains. After a long uptrend, the formation of a hanging man is bearish, because prices hesitated by dropping significantly during the day. Buyers came back into the currency, and pushed price back near the open, but the fact that prices were able to fall significantly shows that bears are testing the resolve of the bulls. What happens on the next candle after the hanging man pattern is what gives traders an idea as to whether or not prices will go higher or lower. Inverted hammer. It is the mirror of the hanging man pattern. The candle looks like a shooting star, but it appears on a downtrend. Engulfing. Bullish engulfing. It occurs in a context of a downtrend. It consists of two candles, the first being a red small-bodied candle that is engulfed by a second green large-bodied candle. The green candle must have a lower low and a higher high than the red candle. It indicates immense buying interest. They exhibit extreme market sentiment. In other words, a bullish engulfing pattern tells us that the buyers have overwhelmed the sellers in the market, thus engulfing the entire previous day's open and closing prices. Conversely, a bearish engulfing candlestick pattern tells us of the sellers overwhelming the buyers, and thus indicative of a drop in prices. Engulfing candlestick patterns can be traded as a reversal candlestick pattern, when found at the tops or bottom of a short-term trend, and validated by support or resistance levels. When an engulfing candle is formed within a trend, they are to be traded as a continuation pattern. One thing to quickly notice. In order to obtain an engulfing pattern, price must drop or jump, creating a gap. It is therefore useless, like most technical traders do, to search for them in 5 minutes, 1 hour, 4 hours chart, and even daily. The likelihood of spotting one is where the price gap, and in Forex this happens on the weekend closure. Therefore, I would advise to look at weekly and monthly chart to try to find one. Bearish engulfing. It occurs in a context of an uptrend. It consists of two candles, the first being a green small-bodied candle that is engulfed by a second red large-bodied candle. The red candle must have a lower low and a higher high than the green candle. Morning star. It occurs in a downtrend, and consists of three candles. The first candle has a large red real body. The second is a small-bodied candle, red or green, that closes beneath the low of the first candle. It represents indecision at a major turning point. The third candle is a large green real body, that opens above the small candle, and closes above the midpoint of the first candle. Evening star. It occurs in an uptrend and like the morning star, consists of three candles. The first candle has a large green real body. The second is a small-bodied candle, red or green, that closes above the high of the first candle. It represents indecision at a major turning point. The third candle is a large red real body, that opens below the small candle, and closes below the midpoint of the first candle. Bullish harami. it is a two-candle pattern that occurs in a downtrend. The first candle has a large red real body and is followed by a green small-bodied candle, whose body is located within the mid-range of the previous candle. Bearish Harami. Like the bullish Harami, it is a two-candle pattern, but it occurs in an uptrend. The first candle has a large green real body, and is followed by a red small-bodied candle, whose body is located within the mid-range of the previous candle. Three white soldiers. It is a bullish reversal pattern that occurs in a downtrend. After several bearish candles, red, three consecutive large bullish candles, green, form. The second and third candles open above the previous candle's low, usually in the mid-range of the previous candle, and close above the previous candle's high. It indicates that the trend has changed, and the bulls have taken control. Three black crows. It is a bearish reversal pattern that occurs in an uptrend. After several bullish candles, green, three consecutive large bearish candles, red, form. The second and third candles open below the previous candle's high, and close below the previous candle's low. It indicates that the trend has changed, and the bears have taken control. Doji. It's a candlestick that forms when the opening price and closing price are virtually equal. It means that during the trading day, the price moved higher and lower and neither the buyers nor the sellers were more prominent. The currency pair traded up, and the sellers stepped in and traded low, and the buyers stepped in. The Doji is often mistakenly referred to as a reversal candle. Actually, it only indicates indecision. It tells you that the number of buyers and sellers has become equal. However, they can tell you more or less information based on the length of the wick. Like in our test. Doji star. It is a Doji that forms in an upward trend, and that is followed by a red candle, indicating a change in direction. The uptrend is about to reverse. Prior to the Doji, is a large green candle indicating that buyers are jumping in after a significant advance. The evening star shows inability to move higher, and the red large-bodied candle following confirms that the sellers have entered the market. Morning Doji star. It is a Doji that forms in a downward trend. It is preceded by a red large-bodied candle, and followed by a green large-bodied candle. It announces an oncoming uptrend. In a Doji pattern, the market explores its options both upward and downward, but cannot commit either way. After a long uptrend, this indecision manifest by the Doji could be viewed as a time to exit one's position, or at least scale back. Similarly, after a long downtrend, reducing one's position size or exiting completely could be an intelligent move. It is important to emphasize that the Doji pattern does not mean reversal, it means indecision. Dojis are often found during periods of resting after a significant move higher or lower. The market, after resting, then continues on its way. Nevertheless, a Doji pattern could be interpreted as a sign that a prior trend is losing its strength, and taking some profits might be well advised. Gap. Gap are an important concept in technical analysis. Whenever there is a gap, Current open is not the same as prior closing price, that means that no price and no volume transacted hands between the gap. A gap up occurs when the open of day 2 is greater than the close of day 1. Contrastly, a gap down occurs when the open of day 2 is less than the close of day 1. There is much psychology behind gaps. Gaps can act as resistance. Once price gaps downward, the gap can act as resistance. Support. When prices gap upwards, the gap can act as support to prices in the future. Often after a gap, prices will do what is referred to as fill the gap. This occurs quite often. Think of a gap as a hole in the price chart that needs to be filled back in. Another occurrence with gaps is that, once gaps are filled, the gap tends to reverse direction, and continue its way in the direction of the gap. The example below shows the gap acting as support. Traders and investors see anything below the gap as an area of no return. After all, there was probably some positive news that sparked the gap up, and might still be in play. Gaps are important areas on a chart that can help a technical analysis trader better find areas of support or resistance. In this example, the gap occurred on the weekend closure. Price went up, then filled the gap, before bouncing from this new acting support. Price patterns. Price patterns are formations which appear on charts, and that have predictive value. They can occur in different time frames. Because we have a tendency to see what we want to see, it can be difficult to treat all chart patterns with 100% objectivity. So, it is better to avoid searching for specific patterns and instead, wait for them to reveal themselves. Price patterns are classified into two categories: reversal patterns and continuation patterns. Reversal patterns indicate that an important reversal in trend is taking place. Continuation patterns represent a pause in the existing trend, or consolidation. The price will continue trending in its current direction. Continuation pattern. Continuation pattern. The first continuation pattern formation is what we call the triangle. Triangle patterns are easy to spot, and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, as well the profit objective, and the amount to be put at risk. Symmetrical triangle. The symmetrical triangle is mainly considered to be a continuation pattern that signals a period of consolidation in a trend, followed by a resumption of the prior trend. It is formed by the convergence of a descending resistance line and an ascending support line. The two trend lines in the formation of this triangle should have a similar slope, converging at a point known as the apex. The price will bounce between these trend lines, towards the apex, and typically break out in the direction of the prior trend. Ascending. The ascending triangle is a bullish pattern, which gives an indication that the price of the currency is heading higher upon completion. The pattern is formed by two trend lines, a flat trend line or key level, being a point of resistance, and an ascending trend line acting as a price support. The most telling part of this pattern is the ascending support line, which gives an indication that sellers are starting to leave the trade. After the sellers are knocked out of the market, the buyers can take the price past the resistance level, and resume uptrend. The descending is just the opposite. unless you are a trained trader, or have abilities to see geometrical shapes easily. The only way to spot a triangle, or any other continuation pattern, is to master trend lines. Remember, in part 1, we focused on how to draw them. A quick recap here, applied to a triangle pattern. If I identify my currency pair, first trending, as a continuation pattern, you want to establish prior trend. So if my currency pair is making higher lows, or lower highs, in this example higher lows, I will try to join those lows, as soon as this is made possible. In here, now. Now, what we are expecting, because of the prior trend up, is another kick up for our trend. This would happen, if more and more buyers are entering the trade, or and more sellers exiting the trade. This is what is observed in a triangle formation like this. Until the apex is reached, here. The bottom line is, if no trend line is drawn early on, you might never see that triangle, or too late. So key to successful and useful trend lines, is, as soon as there is 2 lows, 2 highs, or even 1 high and 1 low, try it. You never know what can come from it. A chart example of a triangle on 1 hour USD/JPY. In this setup, this is the typical way the trade would be taken. Most books, course, or online material will show you an ideal entry to be like this. However, unlike most traders, I do not follow this. Remember that we said earlier on, early entry minimum risk. For me that apply to pattern. While this entry is not wrong, I would consider entering the trade on my trend line. This would make my risk smaller on the event of a failed breakout. In the latter, I could even end up with a small gain. This will be entirely up to you, waiting for confirmation, which I found by experience to be increasing your risk, or early entry, with potential of fail pattern.